A very important session. So, good afternoon or good morning for colleagues joining in the global north, and good evening for colleagues who are in South Asia or in Southeast Asia. This is part of the wider series on Eyes on the Storm, presenting the role of advancing early warning for all. We have started this campaign since March, and this particular session is more on a very specific theme, which is aligned to the ongoing discussion in COP30 in Belém on financing before disaster strike. We have experts who can speak loud and clear on this topic, whether it is on de-risking, whether it is on catnet products or on loss and damage. So how we can finance before the disaster strike? That's an overall question we are trying to ask. We would like to unpack the integration of the role of early warning that also generate a lot of useful data to trigger financial responses to protect lives and livelihood, and including the national economies to de-risk those risks when it comes to hazards like floods, drought, or any kind of natural hazards. I think for most part of the last 20 to 30 years, we have been heavily investing on early warning to ensure that $1 investment will see a net benefit of over 20 plus or $16, depending on the kind of impact that the communities and the country is evaluating. But there is a growing advantage in terms of risk modeling, forecast technologies, but still the gap remains in terms of pre-arranged financing, particularly how we can unfold this anticipatory action and before the crisis unfold directly or indirectly through the number of man-made and catastrophic events. So what we are going to hear a wide range of topic to look at perspective from policymakers, IFIs, government, private sector, largely to understand how this risk financing instruments and the role of early warning can be bundled, for which we have experts from World Bank, Center for Disaster Protection, ION, India Reinsurance, and the International Institute of Environmental Development, Munich Re, and last but not least is the Weather Risk Management Service provider. Each of these panel experts and the panelists offers a unique perspective of how to unpack this work. So we are going to hear what is working, what is not working, what can be done better in times of shocks, what we are going to hear from them. So thank you again for joining us. So let's begin to hear two segment of high-level presentation to hear from World Bank and also from the Center for Disaster Protection. So let me introduce Marcus. He looks after risk financing program in the World Bank, and he has worked with a number of countries. Prior to that, he was working in a wide range of topics in geospatial engineering, climate risk management. Also, he is working with a lot of NGOs, farmers, government, and the development bank. So what we would like to hear from him more about how this risk financing portfolio and the examples of specific countries that he could present on behalf of the World Bank. And followed by, we will hear from Michelle. She's a senior researcher. Her work focuses on how do we really look at enhancing disaster protection. She also co-authored the Center's flagship report on pre-arranged financing, which we are going to lot here today, an in-depth analysis of how they can bring in financing data to structure a better product. And that's about it. So let me ask Marcus to share your screen and highlight your presentation in the next 7 minutes, followed by Michelle. Over to you.
Good morning. Sharing my presentation.
Yeah.
I hope you see it and you hear me. Great. So, Eyes on the Storm, financing before disaster strikes. This is, of course, a core topic of the team, which virtually has the same name, Disaster Risk Financing and Insurance Program at the World Bank. I thought I'd start, rather than just giving you a dry overview of all the countries that we're working in and all the projects that we're involved in, with 3 numbers that sort of motivate me personally. The first one is more than 90%, less than 3%, and more than 300 million. So That's currently the percentage of uncovered disaster losses in emerging markets and developing economies. So there's a huge insurance protection gap. Of course, insurance is not the only approach. Insurance is not the right tool for every scenario, but that's just what it is at the moment. When we talk about the level of pre-arranged financing, the level of financing that is ex ante, not ex post, then that's currently less than 3%. You'll get updated numbers, I guess, in a few minutes. But for 2017 until 22, there was less than 3%, 1.7% on average per year. So there's a lot of potential for improvement. And more than 3 million people are already benefiting from crisis and disaster risk financing instruments per year, as per the Global Shield Financing Facility report that came out earlier this year. So in a world without disaster risk financing, there are a few options, of course. You always have options. One option is traditional humanitarian response. Usually that, or very often, that results in a too little too late scenario. You have enormous uncertainty, you have many delays, so that is not what we want to prioritize. I'm not saying that emergency response will be eradicated, will be eliminated, it will go away. I don't think it ever will. But if there's a way to create a more efficient system that is more forward-looking, that's the way to go. From a sovereign perspective, from a government's perspective, of course, emergency borrowing is an option as well. Then you have all kinds of potential debt impacts, borrowing at terms that are not ideal from a governmental perspective. You have budget reallocations, right? That can completely affect your fiscal management. It might affect your other investments or other projects that you've planned. And then, of course, you can just hope for the best and do nothing, which usually leads to a scenario that has the most devastating impacts on people's lives and livelihoods. So while preparing these slides, I really tried to reduce it to the core of the pre-agreed financing agenda. And one of the most critical elements is, of course, the fact that you don't need all the funding at the same time, right? So what we know is that, particularly thinking about humanitarian programming, forward-looking programming, anticipatory action, if you want to think in return on investment, the earlier you act, the more efficient your programs can be if you manage to translate your early warnings into early action. Usually, if you think about an earthquake, for instance, relief is expensive, recovery is more expensive, and reconstruction blows it out of the water, because the reconstruction for an earthquake is by far the most long-lasting and expensive endeavor. But what we know from a series of research studies and from a series of reports is that the earlier you act, the more efficient the system can be. So, of course, there are many ways to do this, and there's no silver bullet for anything. But the most critical elements to this entire disaster risk financing story, in addition to having the right mindset and a proper understanding of who plays a role, who can act based on what mandate, how different stakeholders can work together, is that we have a series of different tools that are ranging from smaller scale to large scale, that are ranging from simple to more complex, that are ranging from a bit faster to a bit slower. But in the end, it's necessary to understand and to have an open dialogue about which financing instrument actually makes sense. And risk layering is a term that's often thrown around because it just sounds like the most logical thing to do for different problems. You need different solutions. But if you really come up with a risk layering approach where certain instruments target more frequent, less severe events, and others that target less frequent, more severe events, and then a third layer in between, that means that your counterpart needs to understand what these instruments really mean. Another basic idea behind the disaster risk finance story, particularly when we talk about forward-looking mechanisms, is that you really need to think about how to translate data into actionable knowledge. And I'm fully aware that's another buzzword, actionable knowledge, because actionable knowledge really depends on the context and on the technical capacity of the end user and the decision maker. Risk modeling basically just represents our capacity to move away from this mindset that the past will predict the future. If you have 40 years of satellite data available, that does not necessarily mean you have a good idea about the potential hazard distribution or overall disaster risk for the next season. De-risking, of course, huge issue. Huge issue, a huge opportunity at different levels, at the smallholder level up to the governmental level. But in order to achieve all these things, that requires capacity building. And one thing that I believe, too often forget, capacity building without trust building simply doesn't work. And just to wrap this up, of course, there are many challenges. There are many complications, many misunderstandings in the disaster risk finance universe. But if things work out, if we get the right people on the table, we run our simulations, we walk people through scenarios, we have great partners like IWMI on board, we have our counterparts in the government, we have our delivery channels that actually are capable of distributing the funding or making early action a reality through governmental channels, which of course involves civil society, United Nations at the subnational level. The following aspects of disaster risk financing is what we actually want to see and what we've seen work in many scenarios. First of all, it's more predictable, right? There's no guesswork regarding what will actually happen if 80% of your country is affected by a severe drought or any other hazard, right? Of course, there are differences between the onset and the characteristics of different hazards, but throughout most hazards and throughout most financial instruments, we can make things more predictable. Once things are more predictable, things can be a lot faster and a lot less stressful, particularly when you make things truly predictive. Predictions mean a certain risk of false alerts. That's an entirely different conversation and a very important one. But there is some very interesting research, particularly on anticipatory action again, that says the return on investment in several scenarios for anticipatory action can be so high that you can even afford 2, 3, 4 false alerts, comparing the overall costs to a not very well coordinated emergency response operation. So things can be very, very efficient if done right. From a transparency perspective, which is something that is very critical to me personally, as soon as we move into a pre-agreed stage, the transparency almost automatically increases, while the fiscal volatility of a government can decrease. And at the end of the day, it's really about not only evaluating if we've been successful, but about increasing not only the donors or the governments or the subnational actors' accountability, but to be very, very explicit that disaster risks can be mitigated, they can be transferred to international markets, but they will never be zero. And from the perspective of a government, from the perspective of a subnational decision maker, humanitarian partner, whoever you want to focus on, risk ownership is key. So if there's anything you want to discuss in the disaster risk finance realm, here's the contact, and more than happy to chat.
Thank you, Marcus, for this excellent presentation. We will take the question at the later part based on the Q&A chat. Over to Michelle now to share your screen.
Thank you so much. I'll also share my screen. Great.
Yes.
Okay, thank you so much. So just as a very quick introduction, the Center for Disaster Protection is a technical and policy advisory organization, and we focus on improving how the world plans and pays for disasters. I will be talking about the state of prearranged financing report for disasters, which will be coming out next month. So firstly, what is prearranged financing? It's financing that has been approved in advance of a crisis and that is guaranteed to be released when a specific trigger is met. We already heard about the importance of prearranged financing. So we think it helps countries to shift towards a more proactive approach to disaster response. So instead of waiting for a disaster to happen, it can make sure that the financing is there early on and when it's needed the most. So this can also make it less costly and less fragmented. For the past 3 years, we have been producing this report where we start to keep track of the trends that are happening around prearranged financing. And we think it's important to keep track of this, firstly, to drive a shift in the international system towards being more proactive around disaster response, but also to increase the transparency so that there's better information, better coordination, and also accountability around this. So as I mentioned, the report is still work in progress. It will be launched next month. But today I want to talk about some of the key findings from the report. So firstly, we see that international prearranged financing has reached an all-time high of $9.4 billion in 2024. Secondly, we see that this is not evenly distributed across all countries. And lastly, we see that this is a very rapidly evolving landscape. So this means that any future tracking efforts will have to adjust in order to reflect this accurately. When we look at overall international prearranged financing, so that is the total financial protection that is in place so that is available to trigger when it is needed. So we see the sharp increase in the orange line in 2024. And the lines below show the same thing, but for different country groupings. And we see that across the board, there has been this increase. But what we also see is that the bottom two lines, which are low-income countries and fragile and conflict-affected states, that they only get a very small share of the total. So we know that this is less than 7% of the total in 2024. Then when we look at how this is split across the different prearranged financing instruments that we have included in our analysis, we see that contingent loans and grants by multilateral development banks make up the majority of the overall amount. Most of this is by the World Bank and by the Inter-American Development Bank. And it is important to note that most of this, and in 2024, it's 74% of this is in the form of loans that are not highly concessional. So that means that they're more expensive to countries than, for example, grants, obviously, or concessional loans, or subsidized insurance products, like often is the case for regional risk pools. So this is an important thing to bear in mind, especially in a context where a lot of countries face high debt levels and vulnerability around this. And it also partly explains why we see the lower levels in low-income countries. Then when we look at the actual payouts, these reflect what has actually been released from these instruments when they are being triggered by disasters. And we see that this amount has more than doubled in 2024 compared to the previous year. And when we further unpack this for 2024, we again see that a relatively small amount goes to low-income countries. And what we again see in this chart is also how certain instruments are more important to these countries. So again, because of their concessional nature or because they're grant-based. So here, for example, we see that anticipatory action is one of them. Then another thing we discuss in the report is some of the newer and emerging instruments, like climate resilient debt clauses. We acknowledge that for these instruments, there's not yet an agreed methodology on how we best track how much financial protection they provide to countries at the moment. which means that we have to take this into account and get better at like how we capture the overall picture and to keep improving the data around this. So just to wrap up the key findings. So overall, we are seeing encouraging progress around pre-arranged financing, but it is a rapidly evolving space and we need to keep encouraging transparency around what is happening. One of the important things as well to note is that the latest data in the report is for 2024. And this means that the impact of the aid cuts by some of the major donors are not yet reflected in this. So in this challenging context, it's again even more important to keep track of what is happening to pre-arranged financing to make sure that countries do have reliable options available to them for crisis financing. So we look forward to sharing more detailed findings with you next month when the report is launched. But for now, I would like to thank you for your time.
Thank you, Michelle. I mean, it looks so promising to see the level of pre-arranged financing is increasing. I believe that will set the context with the panel experts as we get into more discussion, which will be led by Koli Rao. So let me briefly introduce our moderator today. Mr. Koli Rao is President Senior Advisor for the E.ON India Reinsurance Solution. He brings over 35 years of experience in insurance, reinsurance, and agricultural risk management with expertise in corporate governance, climate risk, and ESG. He has many portfolio when it comes to working in various organizations like World Bank, FAO, WFP, CGR, and IFAD. I think that's the one important choice I would want him to moderate this session. So over to you, Dr. Koli Rao, to introduce the panelists and then take it forward from there. Over to you.
Yeah, happy morning and afternoon and evening, depending upon where you are. So it's my pleasure and privilege to be part of this webinar. And hopefully next 30 minutes, we're going to have a very interesting conversation around this topic. So we have three eminent speakers. Let me introduce Ritu Bhardwaj, who's the director at International Institute for Environment and Development. She has over 20 years of experience in policy development, program management, research areas related to climate resilience, sustainability, social protection. And she's a global voice to bring these, very important topics kind of resonate in the global platform. And we're happy to have you, Ritu, in this program. Then Mangesh, of course, I know him for several years. He's been in the insurance industry for over 17 years. He's a top-class underwriter in agriculture and parametric insurance. He extensively worked in this region as well as in the neighborhood, and brings a lot of insightful, views on the disaster management, including the agri insurance. Then we have Anuj Kumbat. Again, I know him for over 20 years, who's a co-founder of Weather Risk Management Services, currently CEO. Anuj was very instrumental in, setting up weather station network. I mean, at least realize the need for having dense weather station network, and also helping clients with the product development and the weather-based insurance products, operating not just in India, but in other parts of the world as well. So thank you, all three of you. I mean, it's a pleasure to have you. And what I suppose next 30 minutes. Giriraj, we have about 30 minutes. Hello, Giri.
Yeah, exactly.
So what I do is let's try to have a couple of rounds. Maybe I'll go around 3 times. Probably for any question, I request you not to take more than 2 minutes. So before I come to the topic, let me just take a minute to kind of re-emphasize the the scenario, how important disaster management and some of the things we are talking about. India faces increasing frequency and intensity of floods, cyclones, and heat waves. If you look at 2025, almost half of the country had torrential rainfall almost at the same time during the months of August, causing huge losses to life as well as the crop damages, requiring the state governments to spend millions of dollars as a relief. So, and it's not going to get any easy as we face the increasing challenge of the climate change. And Marcus mentioned, in this part of the world, more than 90% production gap for the NatCat perils. That's what the Swiss Re report says. That's what Aon report says, and probably Munich Re as well, because it is a fact. We have to accept that probably we need to do a lot on this. So now, with this little background, I would like to come to Ritu, setting the context with you. We often say early warning save lives. I suppose early financing saves livelihoods. So from your perspective, why is pre-disaster financing becoming indispensable in today's climate landscape?
Thank you. And I'm really pleased that this panel also brings colleagues from the insurance sector, because the point I'm going to make is very central to the insurance sector's capability. So we actually released a paper at COP in which we talked about why some countries continue to underinvest in resilience. We saw Marcus's presentation, which clearly makes, there are different different sectors throw up different types of cost benefit assessment, but overall it's very clear that early resilience investment makes sense, makes economic sense. But you mentioned 2 points. You said early warning saves lives, early resilience, early investment saves livelihood, and that's exactly the point that we tried to make in that paper as well, where we looked at why, despite early resilience investment or early action, governments, MDBs, or even private sector is not investing. And the reason is that they still look at early resilience investment or resilience investment per se as cost rather than something that can lead to return. And this is exactly the point that I'm trying to make with insurance sector reference is, we always typically look at the insurance sector as something that they provide insurance, they provide, coverage against losses that might occur in future. But we, in our paper, tried to look at a different aspect of insurance sector, that is their risk analytical capability. And insurance sector has CAT risk modeling, catastrophe risk modeling, and they run thousands and even millions of those scenarios, but futuristic looking scenarios as to what hazard probability is. And they also conduct a lot of site specific risk engineering. But what it throws up is an assessment of future losses, future expected losses. And a lot of their risk engineering aspect also tells you what resilience measures will help bring down those losses. So we actually use that. So what we tried to argue in that paper was that, of course, insurance sector has that capability, but this capability of risk analytics is something that can be provided as a standalone service by that sector, which can help prove the business case for resilience investment. And we try to make that point by using, we actually partnered with Zurich Insurance to and use their climate spotlight tool to work out what the hazard probability would be for power sector per se, and worked out what the losses would be under different scenarios. And what it worked out to be was, the annual expected losses for those 5 power plants across 5 regions, which is Africa, Asia, Caribbean, Pacific, and so on, worked out to be 48 million. But with early resilience investment, the losses dropped to 9 million. and which over a period of 20 years, it was around $10 billion of saving. And we used the same, we did 10,000 simulation to work out what that losses would be for the entire power sector. Uh, and with resilience investment, we could prevent losses to the tune of 7.5 to 9.6 trillion. Now, the point I'm trying to make is, if you integrate risk analytics and invest in early resilience and not wait for a climate impact to become a disaster, then that makes a pure economic sense. But that intelligence is not available because we kind of don't use insurance sector risk analytical capability in designing these resilience investment, which is something which we can to unlock that investment needs.
Thanks. That's a lovely articulation. And also thanks for bringing insurance into the limelight here, making it a central point of this. Let me now quickly ask Anuj, please keep it to 2 minutes, your comments. So forecasting capabilities have vastly improved, particularly in India, for example, the weather forecast and of course, whatever other forecast related to particularly the cyclone. What is still missing is converting early warnings into early action at scale. So what do you think we should be doing?
You're muted.
Anuj, yeah, Anuj is for you.
Sorry. Hello, everyone, and it's a pleasure to be here. Thanks a lot, Dr. Rao, for asking this question. Some of the things which we are working on is basically using these forecasts to offer forecast-based financing, and we are basically designing actionable triggers for parametric triggers for enabling these forecast-based financing. And that is helping us in offering, or rather helping our clients in offering these services and arranging early cash in the hands of beneficiaries in some cases and with the aggregation organization in others. We've done that in Bangladesh, in Fiji, for instance, and we have worked for that in Zambia also with IWMI itself. And what we are also doing is that we are building the data systems for merging some of these data sets. So what we've seen in some of the countries is that while there is forecast available, the data sets which are required for generating these triggers are basically also the disaster, the relief data in the past, and how these data sets can be used to create both hazard and exposure data sets, and should be easily available on a geocoded basis. So that's what we've been doing. We have merged a lot of these government observation with satellite and model weather data, as well as measured weather data. And this has helped in basically creating those indices or those triggers. And as you might be aware, we have also installed stations across country, and we have started doing that in several other countries, including Bangladesh, including PNG, Guyana, and Philippines. The idea is to strengthening the weather infrastructure, because resilience starts with good measurement, and forecast also needs a good measured values to improve the forecast or localize them. And that's where we are strengthening the weather infrastructure. So these are some of the things which are helping us in translating some of the early action triggers or forecast data sets into basically financing or developing forecast-based financing or early action insurance, as we call anticipatory action insurance, which is offering the payout within 24 hours of the early action triggers. And a lot of these are based on forecasts. So basically, we are paying out before the occurrence of an event, but that is more for resilience building and using this money for building resilience and saving the livelihood, as you mentioned. And this co-development is done by institutions. For example, as World Bank, UNCDF, World Food Program are some of the organizations which are working with in several of these countries. I hope I could answer your question.
Yeah, thanks, Anuj. I also mentioned at the beginning that you're among the pioneers who saw the need for having a good network of weather stations and started setting up. So coming to Mangesh, this particular webinar actually spoke about several tools like parametric insurance, forecast-based financing, contingency lending, ILS and cat bonds are being explored globally to mitigate these disasters. So my question to you, Mangesh, is how do these instruments complement each other in a risk-layered approach?
Sure, Dr. Rao. First of all, thanks for inviting me here, share my thoughts on this important and very critical topic. For those who are uninitiated, reinsurers are basically insurers of the highest order. What we do essentially is we insure the insurance company, and that means we work on wholesale sort of scale. We rely a lot on diversification, and from that perspective, we have to be global in nature. And happy to provide a few examples today during the session from various parts of the globe. I think over the past few years, what has happened is we had focused, there was an era when we had focused a lot on rainfall-based or temperature-based parametric products, where weather stations on ground used to sort of get calibrated, used to measure these events, and then based on the occurrence of the event, the insurance companies used to pay out fairly quickly, fairly objectively. I think those fundamentals of parametric insurance have not changed for sure, but the recent innovations are making the parametric solutions more and more precise, more scalable. We have a lot of satellite data which allows us to measure the droughts, floods, cyclone risks more precisely. And people have gone slightly more innovative these days. Instead of waiting for the incident to happen, why not create a payout structure which allows to pay through a parametric product in anticipation of the event? And that's really, the topic that we can sort of deliberate a bit here in this session. What we can perhaps look at is a multi-layered sort of risk transfer mechanism where we combine various parametric pools with, let's say, catastrophe bonds and maybe reinsurance structures and so on. One example that I can quote here is African risk capacities, drought and flood related coverages, which allows us to see how an anticipatory financing mechanism can work. ARC, or African Risk Capacity, was a partner in structuring Sahel climate catastrophe layer for providing risk capacity for different new products alongside White Food Program. Basically, this links the seasonal forecast to pre-arranged funding for food security interventions. It's a financial protection against severe drought. So in case you have a severe drought coming in Sahel, then using different indices like SPEI, you address this food security challenge. You use the parametric solution in anticipation. That's really the basis of this particular structure. I think generally speaking, the digital platforms are emerging, and as Anuj has mentioned, a lot of innovation is happening in this regard to automate the payouts, to enhance the transparency, and to reduce the transactional costs as well as the speed of the settlement. I think that could also be enhanced. And these innovations usually collectively, they align very well with the predictive analytics that Anuj was talking about, which allows us to bring in more liquidity, rapid liquidity, which makes the anticipatory finance more credible, more affordable, and more meaningful in a way for the sovereign entities. Yeah, over to you, Doctor.
Yeah, thanks, Mangesh. Let me go back to Ritu. I mean, although it's a little bit insurance linked, but I want to come to you. So many policymakers, worry about the basis risk with some of the instruments, particularly the parametric index insurance. So with your experience working there at IAD, I'm sure you may have had conversations and looked into papers. How can we address basis risk through science, modeling, and product design?
See, a big issue is with, like, we are talking about global south. Global north already has a good protection. The protection gap is not huge. You look at global south, there are a lot of gaps out there, especially even if we want to expand insurance coverage, is around the data availability, around capacity, and also awareness, I would say. And the only way we can cover some of these gaps, and we ourselves are trying to design insurance prepayout mechanism with the existing social protection program. So as a starting point, what we did, we have developed a self-diagnostic toolkit called Aspire, so Anticipatory Social Protection Index for Resilience, because to do anything like this, and typically, even if you have early warning means nothing unless you link that early warning to a decision making. Whether you want to pay out an insurance, like, as Mangesh was talking about ARC, whether you link it with some sort of payout or you link it with an existing program or something, where you provide crop compensation or other sorts of compensation for losses. So what this toolkit does is, we have been working with the government to co-diagnose what are the gaps in the existing policy systems and the delivery mechanism. Like simple things like, do they even have a multi-hazard early warning system? If there is a multi-hazard early warning system, have they defined trigger points at which they'll start giving payouts? What would be the package of that payout? And in that sense, working with the actuarials really helps in working out what that package would be. So we have done this across 8 countries and looked at 24 social protection program as to how this could be weaved into and help us in designing, weaved into the existing social protection program and help us design that early package for payout and so on. And we then also looked at some of the we used similar to insurance sectors LEP assessment, loss exceedance probability assessment. Where would be the chance of exceeding LEP with 5% LEP, loss exceedance probability, and the losses worked out to be around 20 billion. But if we use an insurance prepayout trigger mechanism, the same losses can be covered with 10 billion, which should, because it almost cuts down the losses by half, which should make an economic case for investing in data models, investing in covering some of that capacity gaps and creating that awareness. Of course, our approach to the government is not just look at payout mechanism when a disaster strikes or disaster is expected to strike, but also invest early in resilience. The point I was trying to make earlier in response to your first question, that even before, the way we can reduce the requirement for payout is by investing early in resilience. And as part of our assessment, to cover the losses for 20 billion, just 4 billion investment would help cover that losses. And would also reduce the requirement for making those payouts, trigger-based payouts, because we would be taking more people beyond that vulnerability threshold. So, I'll stop there. Probably others have better responses to that questions.
Yeah, Ritu, I'm tempted to ask you actually. You took some examples, fantastic examples, and you're working in several geographies. So, what are the biggest institutional or regulatory barriers you come across? I mean, if you can just take just about a minute to
See, the
answer.
biggest regulatory barrier is the awareness within the government. Even though government knows that that there, and also data gaps.
Yeah.
There is, even in our country, there is IMD, Indian Meteorological Department. There is IITM, which manages the climate data. IMD manages the weather data. Then there are a lot of data silos. The data governance mechanism is not there. People don't pass it on. Plus, there's inhibition within using insurance. Like, why should we integrate insurance with the social protection program? So, not policy and regulatory, I think it's more awareness as to the level of benefit they can derive. The more the awareness and more the willingness to work with other partners and players in the market, even though they are private sector, even though they are from insurance sector, the better the ecosystem for early action and early response would be created.
But thanks. 60 seconds each to Mangesh and Anuj. So how can we build effective, because Ritu mentioned, the public-private kind of. So how can we build effective public-private partnerships to scale these anticipatory risk financing solutions in a country like India?
Yeah, I mean, I can give you some examples from my experience here. One is, as Ritu was mentioning, the data network, whether data network can be built by private sector. But one thing where the public sector needs to come is exposure data and vulnerability data and registries. I guess what very important is that once the event happens, the money has to reach, or the event is likely to happen, money has to reach the person who can use it to minimize the livelihood impact. And that can be done with a good registry data and creation of good registry where the government action is required or support is required. And also the data sets of past such actions. A very interesting example which we have faced is we needed the microfinance data in one country just to understand how the delinquencies have changed in particular areas, each of these areas, and that can be used as validation tool for triggers for anticipatory action insurance. And also another thing which we wanted to use was digital payment network would have reduced the number of transaction counts in the areas which are could have been impacted in the past. And if we can use that data to understand this, how these triggers can be designed using, I mean, other than weather parameter, what else can be used as a trigger for payout? And these are the things where public-private partnerships are important because unless you merge or converge these data sets, you can't create a very accurate systems where the money can reach the right person at the right time. That's
Thanks. Mangesh?
Sure, Dr. Rao. Perhaps I'll try to be concise, but yet allow me a couple of minutes here. I would straight away jump to the Indian example, somewhat linked to what Ritu had mentioned. We have this concept of SDRF. We have this concept of SDMF as well, State Disaster Response Fund and State Disaster Mitigation. These are two separate funds which are established by states for tackling in case major disaster strikes. They are obviously fairly comprehensive in nature. They do look into long-term prevention, mitigation projects, other things. They are also linked in a way. They were established by 15th Finance Commission. Billions of dollars are already invested in these funds. And through these mechanisms, it's already established that you have these early warning systems which are being put up. But at the same time, the current language of the regulations, allow the state governments to also explore insurance as one of the mechanisms through mitigation funds. Unfortunately, what has happened is not too many states have come forward to experiment with insurance product. The only respectable exception here is Nagaland government, which has really tried out a macro level cover against excess rainfall. And they have obviously also invested a lot on weather stations to strengthen the early warning system. So if I were to sort of respond to your earlier question, what is really stopping the governments from adopting such sort of mechanisms? One is, of course, awareness, which Ritu had mentioned, but we certainly need more prescriptive approach to how to use this part of mitigation fund for insurance. I think that is perhaps lacking in the current regulation, and allow me to use this platform, given that the 16th Finance Commission is yet to be out, I believe.
I think the report is submitted, yeah.
Correct. And if we have this prescriptive language somehow mentioned in the regulations, Indian regulations, I think India can be a flag bearer as far as these mechanisms are concerned, where you sort of allow insurance products to coexist with the early
Right.
warning systems. Yeah, yeah. And
Thanks,
perhaps
Mangesh, for bringing.
last example, if you allow me, the
Yeah.
most recent one is CCRIF example, where we had this recent sort of hurricane Melissa, which impacted the Caribbean countries. And there as well, if you see, CCRF has been investing a lot on early warning systems, but the recent hurricane actually impacted so severely that it created payout situation. And there was a very tangible payout of more than $90 million, which has gone to some of the countries. So I think that's these systems definitely work. There's a proof existing in the world currently. So no harm in exploring this. Thanks.
Yeah. Yeah. See, we moved from expenditure to mitigation to the 15th Finance Commission. And I think India certainly have enough budgets, whether it's the contingency fund or the mitigation fund. But the problem I see is the budget rigidity for paying premiums. There's strict regimen and definitions and all that. So I just want to check with Ritu. I mean, what are the experience globally when we have the money? Can we come out of this rigidity so that we can actually pay for premiums?
See, that's a big problem, and I think Mangesh also mentioned about that. There is fund, and it's very clear, like something that we are trying to work with the Senegal government. They have a contingency budget, and a better use of that contingency budget that the government has created is to use that for paying an insurance premium, which will be able to cover much bigger pool of vulnerable population, rather than using it reactively when a disaster strikes, or even just before a disaster strikes. That money will be able to spread much less compared to if it was used for creating a bigger risk pool. Bring insurance sector as a partner, but we are trying to overcome that. We are doing something called Aspire Roadmap. We have started that in Brazil and in Senegal, but hopefully we'll expand that to other countries. It things are beginning to change, but it will take more time. Like, we have to create more awareness within the government, with more of these risk analytics, with more of this benefit cost assessment, that using the budget as a whole, that traditional mechanism will no longer work, because the disasters are increasing in many fold. Last 5 decades, fivefold increase. Their budgets haven't increased fivefold. So obviously we have to look at more innovative ways of dealing with the same problem.
Well, thanks. I think probably we are running out of time, but one last question to all three of you. If you had to recommend one priority action for the government and one for the private sector to scale anticipatory financing, what should that be? Start with Mangesh.
I'll simply steal Ritu's recommendation here. I think let governments really dedicate a certain percentage. It can be even 1%. That's perfectly fine to start with, but certain percentage of the disaster funds towards payment of insurance products, preferably parametric insurance products. So for the government, that would be my recommendation. For private sector, I think as long as they collaborate more, as long as they collaborate among themselves with data providers, like what Anuj has been doing over the last few years, I think there is absolutely nothing that can stop the private players from innovating more. Yeah, thanks.
Yeah, Anuja on the government. Probably you already quoted private sector, but on the government.
Yeah, so I would rather, I was already talking about government, but this is actually pretty useful for the government. The early action, as you mentioned earlier, and Ritu has also highlighted, should be part of the disaster risk management strategy. The early action finance should be part of every disaster risk management strategy, and that would help in uptick in insurance as well as any early action financing or pre-arranged financing. And that is something which is needed. As you rightly mentioned, Nagaland was just one example, but that's also out of the budget. But it should be part of every budget and every action strategy. And that would help in improving the situation.
Ritu, lastly to you.
Thank you. Very I think Marcus also mentioned that in the chat, that through this Aspire toolkit, what we are trying to do is look at the policies, look at the systems, and look at the delivery mechanism. And there, of course, we are looked at, within that we have objectively looked into 67 indicators. Yeah, some of it is like bringing together different players around, and because unless we bring together the civil society, the insurance, the all of the other partners together, that even if we have the amount ready with us, even the delivery of that payout will not be efficient. So there are different elements, different gaps that we have to address, but also in this process look at the opportunities that we can reap into. Like, for example, in India, we have this rights-based social protection program, which guarantees protection of livelihood through MGNREGS, access to food. There's portability of a lot of food aid available now. So we can make use of some of these good opportunities as well. But yes, to make this work, anticipatory action, we need to bring a lot of players around the table and create that willingness in the government to work together with all the players.
Right, that's great. India already has strong early warning systems. I guess the next leap in resilience will come from pairing these early warnings with pre-arranged science-based financing tools, probably that enable swift, localized action before a disaster strikes. So thank you very much, all three panelists, for your curated responses. And now back to Giri.
Thank you, Dr. Kohli Rao, for this panel session. And we have 3 more minutes, but if there is any question from the audience, please raise your hand, or it will be good to have 1 or 2 questions for our audience, from audience to experts. Any questions? You can raise your hand. My colleague can unmute. Okay, I don't see so far, but let me ask one question back to Dr. Kohli Rao, because we didn't ask him any question. So, I mean, listening to all these things, like there are a lot of pilots and evidences, what Mangesh presented, and also Ritu was talking about, Anuj. How do you see, with the kind of shocks you introduce in the early context of your message, how viable a national level scaling model is widely adaptable in the coming years? What is stopping? Because already we talked about silo, data issues and all. What is still 2 major things that we need to address in the next 2 years?
Well, I think what you're asking is actually covered by our experts in different questions. But I think the fact is, if you're talking about Indian context, so it's a kind of subcontinent. So like there's nothing like one size fits all kind of. So even within the PMABY, we have it's a countrywide program, but it's got a lot of kind of customization at the state, district, and the insurance unit level, crop level. So I think as long as we allow that customization into the programs, also Government of India rolled out alternate risk sharing mechanisms as well, with cup and cap models. So although they have to be chosen judiciously, so that's one part. Secondly, I think we all been asking for about public sharing of the data. Actually, all the stakeholders should have access to the data on a real-time data, kind of, whether it's land records, it's historical data, yield data, or the weather data. What are the data which goes into this product design or the claims processing should be made available. And there should be a kind of, I also feel often like, there is a kind of a lack of, even at the policy level. After 30, 40 years of crop insurance implementation, we do see kind of lack of proper understanding of the products, and therefore lack of proper steps being taken to kind of integrate some of these the pieces into a more workable model. So I think these are some of the things, but I think I should also mention to you that the government of India has been working, particularly the Ministry of Agriculture and Farmers Welfare is conscious of all these challenges, particularly in the PMAB, where we are seeing regular, almost like once in 2 years, we're seeing like some dynamic kind of changes in the program, use of STEC, when a lot of inclusive, kind of elements have been brought in, stakeholder kind of consultations are happening. It's a kind of it's a long haul. I don't think we're going to have a kind of a ready-made solution overnight, but it's going to take some time. But it's certainly, I think the government is certainly looking at some of these.
Yeah. Thank you, Dr. Rao. Again, thank you all for all the speakers and panelists and also the audience who have stayed with us. I think it's a critical dialogue that is required to continue this kind of a conversation and to work together. And the main theme is of leaving no one behind. I think that's end of the day, that to ensure that every vulnerable population and the infrastructure are protected, safeguarded. And it's a very important topic you are all highlighted. So thank you everyone for giving this opportunity to participant to hear, and have a good day. See you all later. Thank you.
Thank you.
Thank you. Bye.
Thank you.
Thank
Bye.
you very much.
Goodbye, everyone.